I am born to achieve greatness, and so are you. On today's episode of the Born to Achieve Greatness podcast, we have as our special guest, Mr. Tommy Kilpatrick. Mr. Kilpatrick wrote a book and was so successful that he was contracted with infomercial company. For 6 months, Kilpatrick lived on his 3 credit cards to be available for radio interviews to promote the book in anticipation of making the promise of $100,000 a month. One of the other authors contracted with the same company got into trouble with misleading information. So all new authors' contracts were canceled, and Kilpatrick was left holding $85,000 of credit card debt.
Born to Achieve. Born to Achieve. Welcome to Born to Achieve podcast, the show that inspires and motivates you to unlock your full potential and achieve your goals. With your host, Warren Andrew Pinder. Let's get started on this week's episode of Born to Achieve. Born to Achieve.
Welcome back to the deep dive. Today, we are wrestling with a truly staggering claim, highly contentious, really, about personal finance.
Yeah, it's quite something.
We're diving deep into this assertion that a lot of the credit card debt people carry, well, that it might not be legitimate debt at all, but instead the result of what our main source today calls worldwide bank fraud.
That's right. Our focus today is completely on the, let's say, the journey and the specific methods of Tommy Kilpatrick.
Okay.
He's arguing that the way bank-issued credit cards work, well, it violates some basic accounting rules.
Okay.
And even federal banking regulations for what constitutes a standards loan.
So we need to really get into the mechanics of his argument, don't we? Why he's shouting fraud and what this legal and, frankly, linguistic strategy is that he came up with.
Exactly. We need to understand how he challenges these alleged balances.
So our mission here is to unpack Kilpatrick's claims. We'll look at his source material. You mentioned banking texts and what he actually did. We're looking for those aha moments, the twists, the details that might make you, the listener, think differently about your bank statements.
Okay, so let's start where it all began for him. An $85,000 problem. That's the catalyst.
$85,000. Wow. How did that happen?
Well, Kilpatrick had a successful book launch, contracts lined up, expecting good income. So he ran up charges on 3 different credit cards. Felt pretty secure, you know.
Okay, makes sense. Anticipating income.
But then, bam, those deals just evaporated. Problems with another author, apparently. Suddenly, he's stuck with this massive debt. His words were, he felt quite depressed.
I can imagine that's a huge financial shock. But this is where his background kicks in. He had some accounting training, right?
Yes, exactly. He was actually studying to be a CPA. Didn't get the final credential, but he knew the basics, the foundational rules of business accounting.
And that led to some kind of insight about the debt.
A critical one. He realized the bank was missing 2 key documents, essential for any true loan or debt instrument, in his view.
Okay, what were they?
First, he realized they didn't have an invoice, like a proper invoice for the debt.
An invoice. Sorry.
Second, he remembered something from his required reading back in accounting class, a publication from the Federal Reserve itself.
Oh, what was that?
It's called Modern Money Mechanics.
Modern Money Mechanics. Okay, hang on. That sounds important. That takes this beyond just his personal situation, doesn't it? What does that text say?
It really does. It basically explains how banks create money. And this is the absolute core of Kilpatrick's argument.
So
The text describes how banks take a consumer's promissory note, that's your promise to pay back the money, and they treat that note as an asset.
an asset. My promise is an asset to them.
That's the interpretation. They use that asset to then create a liability on their books, which is the loan amount they deposit into, say, your checking account. They essentially write the money into existence against your promise.
Wait. Are you saying, according to this Federal Reserve document, as Kilpatrick reads it, the bank didn't actually risk any of its own cash? They just used my signature, my promise.
That's precisely Kilpatrick's interpretation. And if you think about it, that completely flips the script on the relationship, doesn't it?
It really does.
So Kilpatrick thinks if he never signed a proper promissory note specifically for this loan, and if the bank didn't use its own funds,
yeah,
and maybe most importantly, the bank didn't actually sell him anything tangible.
Right. They didn't sell him the goods or services.
Then who exactly is the lender here? And that led him to his big conclusion. No invoice, no promissory note. Therefore, no debt.
Wow. Okay. That's a bold conclusion. So what did he do then? Just stop paying?
Oh, he went bigger than that.
Yeah.
Much bigger. He filed 3 federal lawsuits against the banks.
Federal lawsuits based on this theory. It's incredibly audacious. What was his strategy?
It was actually pretty simple, but high stakes. He bet that if he could get the bank employees into a deposition under oath, they wouldn't be able to produce the specific invoice or the promissory note for his credit card balance. Because, according to his theory, those documents just don't exist in that form for these types of accounts.
And lying under oath? Perjury? That's a big deal.
Exactly. Too risky for a bank employee.
Thank you for joining today's podcast. We'll be right back.
Achieve Man, written by Warren Andrew Pinder and Dominique Bradford. This book passionately focuses on the challenges women have been made to go through and how to overcome them. In some cultures, being a woman disadvantages the girl child. This book carefully exposes the hurdles you might face. This masterpiece is the ultimate self-help guide for women. It reveals your true purpose and identity. Get your copy today. Available from Amazon.
We now return to today's podcast.
So what happened in court? Did it work?
Well, the actual court appearance was almost comical, anticlimactic. He goes in, the judge asks about the card. Kilpatrick mentioned something about it starting like a gift card.
Uh-oh.
Yeah. The judge apparently called him an idiot right there for admitting it was now labeled a credit card and then just dismissed all 3 cases. Boom, done.
So he lost. Completely shot down.
In court, yes.
Yeah.
Publicly, quickly, embarrassingly lost. But, and this is the really weird part.
Go on.
About a month later, he checks his credit report. All 3 banks he sued. The debts were just gone, wiped clean from his report.
What? Seriously?
Seriously. And not only that, his credit score actually went up.
No way. So the judge dismisses him, calls him an idiot, but behind the scenes, the banks basically folded.
It certainly looks that way. It suggests they were maybe more concerned about that deposition, about having to produce those documents under oath, than they were about fighting the lawsuits themselves.
So avoiding that potential failure of document production hitting the public record was worth more than the alleged debt.
That seems to be the implication. And for Kilpatrick, this outcome was huge. It validated his whole theory, at least in his mind.
And that leads us to his big advice, the core tactic.
Yes, the power of language, specifically one word.
Let me guess. Alleged.
Bingo. Always, always use the word alleged. Alleged credit card debt. Alleged balance.
Why is that so critical?
Because language creates legal reality in a way. If you say my credit card debt, you've just admitted it is debt. You've accepted their premise. Game over, potentially.
Ah.
But if you say this alleged debt, you haven't admitted anything. You're putting the burden of proof squarely back on them. They have to prove it's a legitimate, legally constituted debt.
And proving it requires the documents, specifically the accounting documents. He keeps coming back to the invoice rate.
Absolutely. Standard Business Accounting 101, he argues. You only pay from an approved invoice, never from just a statement.
What's the difference in this context? Why is a statement not good enough?
A statement is just a summary, a snapshot in time. Might be wrong, might not show a recent payment.
Yep.
Critically, it's not the instrument that created the debt in the first place.
Okay.
The invoice, he says, is that required debt instrument. If the bank can't produce an invoice showing they sold you something, how can they claim you owe them directly?
Right, because they didn't sell the product. The merchant did.
Exactly. Which connects to his broader point about what defines a real standard bank loan, the kind you get for a house or a car. He says bank-issued credit cards are missing 5 key things.
Okay, let's break those down. What's missing?
Number 1, proof of income. Properly verified, he means, which is legally required now to prevent predatory lending. Often looser with credit cards, wouldn't you say?
Often, yeah. Number 2.
Collateral. Something tangible the bank can seize if you default, like your house title for a mortgage or the car for a car loan. Credit cards are usually unsecured.
True. Number 3.
A formal credit report reviews specifically to determine the interest rate for that loan based on that risk. Again, sometimes streamlined for cards.
Okay, those first 3 relate to risk assessment and security. What about the last 2? These feel like the real linchpins for his argument.
They absolutely are. Number 4, the signing of a proper promissory note, that legally binding promise to pay back this specific loan under these specific terms.
Which he claims is missing for credit cards. And number 5.
Number 5 is about the application itself. He argues the credit card application you fill out is just a request. It's not the actual loan contract because it lacks those other elements, especially the promissory note.
So based on those missing pieces, he differentiates types of debt. We need to be really clear here. Kilpatrick insists this isn't some magic wand to make all debt disappear, right?
Absolutely not. He's very careful to make that distinction. This is not a universal get-out-of-debt-free scheme. He draws a very sharp line.
Between what and what?
Between true debt and what he calls alleged debt.
Right.
So store cards. Let's say you get a card at a tire shop, buy tires, and drive away. That's true debt.
Why?
Because the merchant, the tire store, provided a product. They have an outstanding unpaid invoice for those tires. You owe the merchant. That's straightforward.
Got it. So where does the alleged fraud come in?
It comes in with the major bank-issued cards. Think a Walmart card issued by, say, Capital One, or an Amazon card issued by Chase or Citi, those big players. That's what he labels the worldwide fraud.
Because?
Because the bank didn't sell you anything. Bank of America didn't install your tires. Citibank didn't ship your Amazon package.
Okay. So how did the merchant get paid?
Kilpatrick's theory is that the bank pays the merchant, sure, but it comes out of the bank's internal budget for advertising or customer acquisition.
Customer acquisition, like a cost of doing business to get you on their books.
Precisely. Yeah. Which leads directly into his gift card theory.
Gift card theory. Okay, explain that.
He suggests that the initial credit limit you get, say $500, isn't really a loan. It's effectively a prepaid gift card given to you by the bank to acquire you as a customer.
A $500 gift card? How does the bank make money then?
Not off that initial $500 principal, he argues. They make it back, and then some, through fees. Annual fees, late fees, over-limit fees, foreign transaction fees.
Right, there are a lot of fees.
He claims the average person pays something like $234 a year just in fees. So the bank recoups that initial $500 gift in, just over 2 years, just from fees, before interest even kicks in heavily.
So the initial advance is just bait, and the profit comes later from fees and interest on revolving balances.
That's the theory. Get the customer hooked, then profit from the ongoing relationship.
Okay, now here comes the part that sounds, really counterintuitive. Kilpatrick claims that when you pay your credit card bill, you're actually making a loan to the bank. How does that work? That sounds legally backwards.
I know, it sounds wild.
Oh.
But it follows his core logic about the missing promissory note and the sorts of funds.
Explain the logic then. If I pay Citibank $500, how is that a loan to Citibank?
His reasoning is, since the bank never truly loaned you that initial $500 from their own secured capital via a proper loan structure, that $500 payment you make isn't technically debt repayment.
So what is it then?
In his view, it's the first time your actual capital is entering the equation. You are depositing $500 with the bank into this account structure.
Depositing, like into a checking account?
Sort of. Functionally, yes. So from that point forward, every purchase you make using that card, you're spending your own money that the bank is holding for you.
Wow, okay.
This means the card isn't really a credit card anymore. It's acting like a debit card, just disguised. A debit card where the bank gets to charge you interest and fees for using your own funds.
That completely reframes the entire relationship. If that interpretation holds, it's a huge if.
A massive if. But that's the foundation of his argument.
Now for a commercial break.
Achieve Men, written by Warren Andrew Pinder. In this book, you will learn the 7 steps to achieving your dreams and goals. Given the vision to share how the acronym of the word achieve can be used systematically in your day-to-day life. Each of us is given a unique gift from God. Get your copy today. Available in print, ebook, and audiobook from Amazon.
We now return to today's podcast.
So, moving from theory to practice, Kilpatrick didn't just figure this out for himself. He started helping others, right? Through a charity.
Yeah, he framed it as helping people stop being crime victims. He developed a specific process, often involving sending a particular letter, and claims he could get these alleged debts removed and credit scores boosted, sometimes in just 45 days.
And he claims he found people money they didn't know they had, like that podcaster example.
Right. He mentions finding one podcaster $20,000 they were supposedly owed back, based on this framework.
So what's the remedy? What's the process he advocates for consumers who want to challenge these alleged debts? It's a 3-step thing.
Yes, a clear 3-step process. Step 1 is basically gather your evidence.
Which is?
Your own credit report. He says that report showing a debt reported by a bank that isn't the original merchant is the initial evidence of the alleged crime. It documents the claim you're about to challenge.
Okay, so get your credit report. Step 2.
File a complaint. But not with the police. You go to the regulatory agencies that oversee banks, state banking commissions, federal agencies like the CFPB or OCC, file a formal complaint outlining the issue, and crucially, keep a copy, proof you filed.
Right, documentation is key. And step 3 sounds like the main event.
Step 3 is the direct confrontation, the letter and the countercomplaint. You send a carefully worded letter to the bank.
What's the letter ask for?
It formally requests they close what Kilpatrick calls the free checking account, his term for the credit card account, and mark it on your credit report as closed by consumer in good standing.
Okay, but it must demand more than that, right? Based on his core argument.
Oh, yeah. This is where the teeth are. The letter must demand the bank provide certified copies of 3 specific things.
The missing documents.
Exactly. 1, the outstanding unpaid invoice for the alleged debt. 2, the certified promissory note you supposedly signed. And 3, an affidavit of debt.
An affidavit? What's the significance of that?
That forces a specific bank employee under oath via the affidavit to swear that the debt is real and those documents exist and are valid. If they don't exist, signing that is perjury. It puts personal liability on the line.
Very strategic. And this letter doesn't go alone, does it? There's a counter-complaint.
Right. You include a pre-drafted counter-complaint with the letter. This is basically a legal document showing you are fully prepared to sue them if they don't comply or if they try to sue you.
And what's in that counter-complaint? Why is it so intimidating to the bank?
It signals you're serious and know the legal game. It typically includes demands for document production, which they likely can't meet, per the theory, formal written questions called interrogatories, which are expensive and time-consuming for their lawyers to answer under oath, and potentially a request for an injunction.
Explain interrogatories and injunctions again. Why are they such deterrents?
Sure. Interrogatories are just a huge hassle and expense.
Sure.
Lawyers have to spend hours crafting sworn answers. An injunction is even more powerful. It's a court order that could immediately stop the bank from collecting the debt or even reporting it to credit bureaus while the case is ongoing.
Okay. So the bank's legal team sees this package, the demand letter, the affidavit requirement. They're ready to go counter-complaint with interrogatories and an injunction threat.
And they do a cost-benefit analysis. Is this alleged $5,000 debt worth the legal fees, the employee risk with the affidavit, the potential public embarrassment if they can't produce the docs, and the risk of an injunction?
Probably not in many cases. It becomes cheaper and safer to just make it go away. Write it off. Remove it from the credit report.
That's the strategy. Make it too painful for them to pursue.
But what about the damage to your credit score? People worry about that. If you fight a bank, doesn't your score tank?
Kilpatrick addresses that head on. He says his own score went down to 0, essentially, when he first started this fight.
0? That's terrifying.
It sounds bad, but he claims he rebuilt it relatively quickly. He immediately got a new small limit Capital One card, used it responsibly, then got a small installment loan from a credit union, paid everything on time.
And the result?
He says he got his score back up to 7 and 10 within about a year. So his point is, yes, there might be a temporary hit, but it's not permanent financial ruin. It's a short-term cost for potentially eliminating a much larger alleged debt.
Okay, so let's wrap this deep dive up. The core claim from Kilpatrick. Balances on bank-issued credit cards often aren't true debt. Why? Because the bank didn't follow standard loan procedures, no proper promissory note, no invoice from them. They didn't provide the product or service.
Right. And he argues their profit model relies heavily on fees generated from these accounts, structured in a way he claims is fundamentally flawed, even fraudulent.
And we absolutely have to repeat the disclaimer, the one Kilpatrick himself makes.
Yes. Don't just run out and do this based on our conversation. You absolutely should verify these claims. Talk to a qualified professional, a CPA familiar with banking, or an attorney specializing in consumer law in your specific area before taking any action. Understand the risks and the laws where you live.
Definitely. So the final thought here is pretty provocative. Kilpatrick tosses out this number, maybe a quarter of major bank profits worldwide, he suggests, could be tied to this practice. He names London, Tokyo, India.
Basically says it's global.
Which he labels a crime.
Right. So if he's even partially correct, What are the real implications? What happens if suddenly millions of people worldwide started demanding that specific invoice, that promissory note for their alleged credit card debts? What would that do to the global financial system? That's something to really chew on.
Thank you for tuning in to this episode of Born to Achieve. Born to Achieve. We hope you found it informative, inspiring, and motivating. Born to Achieve. If you enjoyed this episode, please share it with your friends and family. Stay focused on your goals, and we'll see you on the next episode of Born to Achieve.
Take advantage of this incredible opportunity. Sign up today and claim your free ebook at www.borntoachievegreatness.com. Follow us on Facebook at Achieve Movement Inc. Get your copy of Exploring Achieveland, A Journey to Realize Your Dreams, Motivational Stories of Kindness, Inspiring Stories for Kids on Amazon and Kindle.